Have you ever looked at your bank account and after a big job and wondered, where the heck did it all go? Well, you're not alone. Most contractors are running million-dollar crews on $50 cash flow. And today, we're fixing that with the Profit First system. We're gonna go step by step. Hey, it's Steven with Savvy Tax Strategies and Bookkeeping and the Savvy or Surrender podcast. And today we're getting painfully practical. If you're a small contractor, general contractor, handyman, an HVAC, electrical, plumbing, and your bank balance feels like a yo-yo, this is your blueprint. We're going step by step to set up Profit First the contractor way. By the end, you'll know exactly which accounts to open, what percentages to use, and what to do this week to get your cash under control. And by the way, if you like this information but are having a little hard time getting Profit First implemented, we can help you with that. Reach out to us at meetwithsavvy.com or just check out our website, savvytaxstrategies.com. Schedule a discovery call. And we'd be happy to talk to you and see what we can do to help you get Profit First implemented in your business. As certified Profit First professionals, that is what we love to do for business owners. And don't forget to subscribe to this podcast. Hit the subscribe link there in YouTube or follow us anywhere you get your podcasts, Apple, Spotify. We're there everywhere, including savvyorsurrender.com. Leave us a 5-star review. I would really appreciate it. All right, so let's jump right into it. So Profit First flips the traditional sales minus expenses equals profit into sales minus profit equals expenses. Now, that may sound like it's not really that big of a deal, but really it's a mindset shift more than anything else. By the way, before I get going too crazy into it, on the video here, you can see the book that we're talking about is Profit First. It's a Amazon bestseller, been around for 11, 12 years now, sold over 1.4 million copies. The author, Mike Michalowicz, wrote the book after being an entrepreneur and losing his shorts in a couple different businesses. And so he figured out a different method of accounting. The simple way that I talk about it, if you're not familiar with Profit First at all, here's how I refer to it. If you remember, maybe you did it, maybe your grandma did it. I know my grandma did it, where she had the envelope system for her budget, for her personal budget. So she'd get her Social Security check at the beginning of the month or whatever it was. She'd cash it out and she'd put cash in the different envelopes through for rent, for electricity, for gas, for groceries, all those things. And when she was done with the money in that envelope, that meant that was it. That there was no more gas or there was no more groceries or whatever, or you had to steal from one of the other envelopes. It's the same concept here for business owners, but instead of using envelopes and cash, you're using bank accounts. So we're going to open up 5 separate bank accounts to direct our cash on purpose. We're going to have a profit account, an owner's pay account, a taxes account, an operating expense account or OPEX. And the contractor twist here is that we also want to isolate materials and subcontractors so that those dollars don't sneak into your operations. Because if you've ever felt rich until your vendor bills hit, then that's exactly why. So we want to talk more about real revenue. So in the book, it breaks down exactly how to do all of that, of course, and shows you a step-by-step way. However, I have learned that working with different professionals, contractors, different business owners, as they try to implement Profit First, it fails in 2 areas. One, they get the bank accounts open. That's easy, right? You go to the bank, you have a couple extra accounts opened. That part's not too hard. Getting them to start allocating and moving the money from one account to the other ones, that's where I see a challenge. It just ends up not happening. They don't move forward with it. And then if they do that part, the next challenge seems to be when it's really a budgeting thing. And it's kind of the whole reason why Profit First exists. So the idea behind Profit First is if you have this big bank account, call it bank balance bookkeeping. meaning you go into your bank and you look at how much money you have available to spend. When you do that, you tend to not think about things like, paying yourself or making sure the business is profitable or making sure you have money to pay Uncle Sam at the end of the year. So when you aren't taking those things into consideration and you're just spending everything that's in your account, you are not a profitable business. You're running from job to job. You're taking a job that maybe you don't want to take, but you need the money, the cash flow to be able to come into the business so that you can make payroll or whatever it is. So by having these extra accounts, the idea is then you have smaller bank accounts to be able to look at. So all the money comes into one account. That's the income account. And then from there, you immediately put a percentage, and in the book, and later on, we're going to go through a little bit of it, but you put a percentage into profit account. Hey, if this is your first time doing it, by the way, you can do 1%, right? Like this doesn't have to be some crazy amount where all of a sudden you're putting 10% of your money into profit. So you put 1%, 2%, whatever it is that you can do into the profit account, and then the owner's pay account, and then the tax account. And depending on your level of income, depends on how much those percentages should be. It breaks it down in the book there too. So from there, we've got the profit account, the owner's pay account, we've got the tax account. Whatever's left at that point then goes into your OPEX account. Now, the point with contractors is we want to make sure that we're taking that real revenue only and getting rid of the money that you'd spend on materials and contractors. So your real spending power isn't gross revenue, it's real revenue. Real revenue equals your total income minus the materials and subcontractors. You don't earn M&S, right? You don't earn materials and subs. You pass it through. So we build targets on our real revenue, not gross. This one shift prevents 80% of the cash chaos that I see with contractors. And then as that second part of the issue when you're implementing Profit First is you don't adjust your expenses. And that's really the key to the book is you're adjusting your expenses to live within your means of the business, of what's coming in. Because now you've already gotten your profit for the business. So now you're more profitable. You're showing that you're not just a hobby. You've got your owner's pay, again, your paycheck for working in the business. I've said this on other podcasts, episodes. It's so funny because business owners, and I'm guilty of this myself as well. I've done this too. So I'm not, throwing shame at business owners and saying I'm perfect there. By no means. Business owners will, make $100,000 a year or whatever it is, working 40 hours a week, and get tired of that and say they're going to strike it out on their own. And so they open up their own business. And instead of working 9 to 5, now they're working 5 to 9, right? 5 a.m. to 9 p.m. By the way, here I am, it's 6:30 in the morning and I'm recording this podcast. So, I'm living that life still. But when you do that, and then you don't pay yourself a fair wage, right? You're paying yourself 30, 40, 50,000 a year or whatever it is again to be able to barely make ends meet because you're quote unquote reinvesting into the business. Well, when you do that, you're setting yourself up for burnout, number one. And then eventually you look at it and you say, is this even worth it? Maybe I should just go get a job again. Maybe being a business owner is not meant for me. Right? All those things start going through your head. So an employee quits as you try to scale, or you have a medical emergency with an employee like I just had, or whatever it might be. When those things hit, if you're not showing a true profit in your business, if you're not paying yourself adequately, it's not going to be worth it for you. You're going to say, this is harder than I expected. It's not worth it. And you're going to move on. And I want to avoid that for you. I want entrepreneurs to be successful. I want you to be able to see all the fruits of your labor of building this business come to fruition. So to do that, Profit First truly helps you to have that mindset shift of making sure your expenses are adequate for your business, but by having a more profitable business. And if we begin with the end in mind, and we look down 5, 10, 15, 20 years, whatever it is, however old you are, when you want to retire, when you want to sell that business, maybe do something else, whatever it is, you want that business to be profitable because you want to be able to sell it for a good amount of money to be able to do whatever you want to do next. And if you're just simply barely making ends meet, if you're paying everything out of your business account and it's all going to operations and payroll, and you're not paying yourself adequately and you're not showing a profit, it's going to be much harder, one, to sell the business at all, but two, to sell the business with any kind of a variable or of multiplier so that you can actually get a true amount of money for the businesses. Okay, so that operating expense account, that's last. Whatever's left in there, that's what you pay your expenses. But here's the issue, is I will see contractors, but all business owners, they will have whatever's left in that operating expense account, but they didn't adjust their expenses. So all they did was they took the profit, the owner's pay, and the tax amount out of that account. And so now all of their expenses are still going into the OPEX account. And what happens? They go into overdraft and they have all these overdraft fees now, or they have to rob one of the other accounts, usually the tax account and the profit account, because they've already paid themselves and they've used that money, right? But so they'll rob either the tax account or the profit account to pay those expenses because they didn't make any kind of adjustment. So working with a certified profit first professional, not only do we help work that in, but we also figure out what your monthly burn rate is or your monthly nut. And we go through that exercise and figure out what exactly you need to make every single month. We also want to factor in things with cash forecasting, like retirement account or whatever it is you want to build up. You need new tools, you need new trucks, whatever that happens to be, we put that into there as well. And then we also look at your expenses, and we want to make sure that your expenses are exactly where they need to be. Where could we cut? Could we cut some interest rates on some credit cards or shave down, the cable bill or internet bill or whatever it is? We look at all those expenses and figure out where you can cut if needed to be able to get closer to your target allocation percentages for your business, which is the next area that we're going to talk about. So once you have those 5 accounts, and maybe you have a bonus account for payroll or something like that, you can have multiple accounts. Some businesses have dozens of accounts. I personally have 8, I think it is. I opened up one for when I was moving into my new building. I had a builder account so that I could build the business or build up the office building. And I chose not to do that. Ultimately, I chose to buy a suite or it's basically a commercial condo that I bought. So I did that instead of building my own office, but I've still got that account there and I'm still putting some money in it because I'm going to outgrow this suite as well. And I'm going to need a bigger office building at some point. So I want to continue to put money in there and feel that. So anyways, those are the accounts. Now let's talk about the target allocation percentages. So your starter TAPS for a small contractor, TAPS meaning target allocation percentage. This is where we want to get to, right? This is our target of how much money we're going to move from the income account into those other accounts. So for a small contractor, let's say under $1.5 million of gross, we've got the M&S, your materials and supplies, of course, right? We just need to take that right off the top. We don't even count that. And then we have your profit account. Should be somewhere, the target, again, is somewhere between 3 to 5%. Now, if you haven't been paying yourself a profit at all, we need to start small. 1% is perfectly fine. The key is to start. Immediately, you want to start putting money into that profit account. I don't care if it's $5, $10, whatever it is. Start to see how your business is profitable. And we'll talk about when you do this, okay? So that's going to be next. But right now, let's just talk about the owner allocation or the target allocation percentages. The next account is the owner's pay. Should be, again, for a small contractor making less than $1.5 million a year in gross revenue, is the owner's pay should be somewhere between 35 and 45%, just depending on where you're at. If you're solo, if you've got teams or crews, maybe you need to be a little bit lower because you've got to make payroll. So right around that 35 to 45% range. Taxes, talk to your tax professional, aka Savvy Tax Strategies and Bookkeeping. But taxes should be somewhere between 10 and 15%. If you've got a lot of equipment, you can depreciate, things like that. Maybe you can go a little bit lower. You might have to go a little bit higher. You can look at your effective tax rate that you paid last year. If you don't know it, ask your tax professional what your effective tax rate was last year so that you can hold that percentage out. And then, we're not in this episode, we're not going to get into S Corps and LLCs and how much percentage you need to put away and all that kind of stuff. Just know that you need a tax account and you should be putting 10, 15% away at least every time you allocate your money. And then the final one is your OPEX, right? That's the remainder, and that's going to be 30 to 45% depending on your crew size, overhead, things like that. And maybe you have a buffer account again when cash is a little lumpy, right? You got the ups and the downs. 2 to 5% can go into there. And so your goal is to get there. So you have your TAPs and you have your CAPs. The CAPs is your current allocation percentages. So you break down what you can currently do. So let's say when you're first starting it out, maybe your profit's only 2%, right? So you're going to put current allocation percentage 2. But our stretch TAP, our goal is to get to 10. So we're going to, over the next 8 quarters, go up 1 point. So we're going to go from 2% to 3% to 4%, et cetera, all the way through 10%. So it might take us 8 quarters to get there. Now, if you're an overachiever and you're able to cut expenses a little bit better, then maybe you do it faster. But let's not completely kill the system, because then what happens is it doesn't work and you just say, hey, this doesn't work, and you throw it to the side and you just go back to what you had been doing all along, which, by the way, also wasn't working, right? So let's get our goal, 10% profit, 35% owner's pay, 15% for taxes, and then your OPEX, 40% or less. Those are our kind of our stretch or our ultimate target allocation percentages. Again, this is off of real revenue. Take those materials and supplies out of that, right? That's not counted. Okay, so now the next part is, when do we do this? Well, according to the book, again, Profit First, the book has it as the 10-25 rule. You want to do it twice a month, say on the 10th and the 25th. That's when you do your allocations. So you're going to look at your income account and you split it up. You say, okay, profit 2%. If you got 20 grand in there, you're going to take $400 and you put it into your profit account. And then if you've got, whatever is left for owner's pay, if you're doing 35%, you take 35% of that, and then the taxes, 10, 15%, and then you've got your operating expense account. So when you do that on allocation day, you just sweep the remaining money right into those different accounts, and then whatever's left, basically you move into operating expense. Now, the way I personally do it is a little bit different. I don't wait until only the 10th and 25th. I like to do it weekly, and I feel like everybody should be doing it weekly, especially in the beginning. The exceptions to this are people who get paid infrequently. So if you are a realtor, maybe you don't do it on the 10th and 25th or weekly. Maybe you do it every time you have a closing. If you're not closing a house every week, which most realtors aren't, let's be honest, then why would you allocate on the 10th and 25th? Or if you're a real estate investor and you typically get paid by the 5th of the month for all of your rents, then you do it one time. You do it on the 5th or the 7th or whatever, maybe on the 10th, and you just do it for the 1 month, for the one time a month. So it just depends on your business. Again, the book says the 10th and 25th. For contractors, I'm a huge fan, especially service-based contractors where you're typically getting paid weekly or all the time, right? You're getting paid daily from doing service jobs. I love weekly. I do it on Tuesday. Every week on Tuesdays when I do my allocations. And the reason I love that is because, one, it creates that habit. It makes it easier for you to remember to do. Set up a calendar item in your calendar, and every Tuesday you just go and you get it done. Also, the other thing is, for a lot of contractors, they pay weekly still, right? So if you're paying weekly, it works better if you're allocating your money because your payroll comes out of your OPEX account. So you want to make sure there's plenty of money in there to be able to pay your crew. So that's another reason to pay weekly. I love the habit and the consistency of it, making sure there's money in there to pay your crew. It just works better. Now, how much to ultimately move? So the way I look at my income account is I leave that income account, I leave some money in there just in case, just kind of a buffer. So I typically don't take it down to zero. And in the book, I don't remember specifically, but I don't think he really addresses that. But the idea is really in the income account, only money's coming in. So nothing should be coming out, but I like to leave $1,000 in there. So I'll take whatever the balance is, let's call it $11,000. So I'll take 10 grand and that's where I'm doing my allocations. So again, 5%, whatever it is for profit, owner's pay, and then taxes, and then the OPEX, and that's where all my bills are coming from. The profit account and the tax account, in the book, he does talk about having that at a separate bank. Now, you can do that if you want, preferably one that doesn't transfer back and forth. That's perfectly fine if that works for you. Whatever you want to do there. I have some clients that they do have it at a separate bank, and then I have others that they just have it at that bank and they just do their best to ignore the fact that there's money in there, because it will add up fairly quickly. Maybe not the profit account if you're only putting 2% in there, but certainly that tax account. I have clients that will call me and be like, do I really need $35,000 in my tax account? Make a tax payment and then it'll go down and it won't be so bad. So that's the idea behind allocating, when to allocate. It's really up to you and your business and what makes the most sense. Then quarterly, we want to take up to 50% of the profit account as a distribution. And then the rest we're going to use to kind of build resilience. You can put it into a different account. So here's what I typically do. At the end of the quarter, I will look at my profit account. Let's say in my profit account is $10,000. I will take 50% of that, $5,000. I'll either move that into my personal account, I'll put it into my stock account, whatever I want to do with it at that particular quarter. But I want to celebrate the fruits of being an owner. That's what this profit is. It's a distribution. Hey, congratulations, your business was profitable. What do you want to do with it? The other 50%, so you slice it in half, right? $5,000 is going to do whatever I want to do with it. I'm going on vacation, I'm building it up, I'm paying off the vacation, whatever. The other 50%, you can use it, you can put it in the savings account for the cash buffer so you don't have to lean on a line of credit. You can put it towards your building fund. I use half of that, so 25% of my profit account goes into my building account. That's where I'm putting it currently. So when I take that 50%, right, the $5,000, that goes towards my trips, whatever it is I want to do with that money. The other 50%, 25% of it goes to my building fund. And then 25% goes to the savings account to be able to build that resilience up, to be able to not worry about having to use a line of credit in the slow periods. Behavior beats spreadsheets every time. So you want to make the money move. Then you want to look at what you've got left. And that constraint creates smarter decisions. A lot of what we've been talking about with that operating expense account and the challenges there. So here's what your first 7 days should look like. Let's break it down real quick what we want you to do. In day 1 to 2, whatever it is, get over to the bank and you want to open up your income account. If you're going to have a separate account for your materials and supplies, you can do that. Your profit account, owner's pay, tax, OPEX, and then optional is also like a drip account or another savings account, your building account, whatever you want to do. But ultimately, you want to have at least 5 accounts from the very beginning. Income, you probably already have an account, right? You probably already have one. Maybe you have 2. If you open it up at a credit union, you probably have 2 accounts. Savings account as well. Savings accounts are perfectly fine especially for the profit account and the tax account. Put it into the savings account. That's fine. It doesn't have to always be a checking account. Day 3, you want to pull your profit and loss statement for the last, say, 3 to 6 months. And you're going to compute your average materials and supplies percentage and your real revenue. So figure out what is truly coming in. If you've got $1.5 million real revenue or revenue gross income, but a lot of that is materials and supplies, you got to subtract that out, right? So we're going to look at that. And we're just going to look at our true real revenue. And then, so that's day 3. That's all you got to do on day 3 is just pull that report and figure out your percentages there and what is truly real revenue. Then on day 4, we're going to pick out your starter TAPs, those target allocation percentages from earlier. Remember, just a couple points for profit is perfectly fine. 1%, 2%, whatever it is. If you can do more, if you've been profitable, congrats. Put 5, 10% in there. Start small and consistent, though. You don't want to overthink this. You can always make adjustments, and you don't have to wait for the quarters to make adjustments. Obviously, you can make adjustments whenever you need to. On day 5, put the vendor payments on the material and supplies, or materials and subcontractors pipeline only. So you want to move all those bills to the materials and supplies one, and then your recurring bills to OpEx. So the internet, your CRM, your credit card payments, your phone payments, whatever it is you're having come out of your regular checking account right now, you want to move that over to the operating expense account. So that is one of the areas, remember what I said in the beginning, they open up a bunch of accounts and then they don't start implementing. That's one of the areas of friction, is now you've got this one income account or this one checking account that does everything. And now you're going to try to split it off to where one is just income and one is all of your operating expenses. So that existing checking account, you got to figure out what is easier. Is it easier to just keep that your operating expense account? Most of the time, that's the case. Or if you have a lot of income streams, automated income streams coming in, maybe you leave that account as your income account. Again, most of the time, I'd say 95% of the time, we leave that existing checking account as our OpEx account, and we open a new account for income, especially contractors. You're getting paid by checks. Maybe you have your CRM, House Call Pro, job, or whatever, and you're taking credit cards. So you just have to shift the account number that those credit cards are coming into. So you go into Stripe, whatever it is, and you change that account so that it'll start going into your income account. That's perfectly fine. It'll work a lot easier that way, and leave your OpEx account, your existing checking account, as your OpEx, okay? And then you want to remember to celebrate a real profit transfer. Even 1% counts. So you get paid, immediately move that money into the profit account, especially that first time. Move it into the profit account. Move that 1%, 2%, whatever, and then celebrate the fact that you did that. For a lot of business owners, this is the first time that they've been profitable. And so they see that, and they see the money in that profit account. And let me tell you, this works. This isn't a gimmick. This isn't just something that I do to help business owners and they've got 5 accounts. I have a client that right now, hang on, sorry, I'm ADHDing. Let me finish the days. Day 7. Day 7 is we're going to put our allocations on the calendar. So whether it's the 10th and 25th, whether it's every Tuesday, whatever it is, you want to turn off the auto pay for things that might break the system. If it's a different account, whatever, you want to fix that. You want to move everything, you get those allocations put on the calendar, okay? So that's day 7. That's your first 7 days. That's your first week of what you're going to do. Okay, so pitfalls. Using your materials and supply and subcontractors account to cover OpEx. That's stealing from jobs. You got to stop it at the source. So again, if you're doing project A and then project B starts and you're using the money from project A to be able to fund project B, all you're doing is you're on this like craftsman cycle. And so you need to stop that. You need each job to be profitable on its own. So you got to stop it at the source. Overpromising allocations. Again, start with 1 to 3% for profit and then make 1 to 2% increases each quarter. Slow is smooth, smooth is fast. It's much easier to slowly ramp up than it is to just immediately start at 5, 10% profit and then again find out it doesn't work and you have to move money out of the profit account to be able to cover expenses. If you think it's exciting to have money in your profit account, to be able to move money into the profit account, think about how demoralizing it is. It's like 2x how exciting it is. It's like 2x how demoralizing it is if you have to take money from that profit account and move it into the OpEx account because you didn't have enough money to pay the bills. So don't do that. It's not that exciting. You want to slowly do this, okay? Tax shortfalls. If you have not planned for taxes, you want to default to 12 to 15% of your real revenue until we can get it kind of tailored and fit for you. And then the other pitfall is ignoring seasonality. If you are a contractor in an area that you have to deal with this, if you're a concrete guy, if you're a painter, if you're a landscaper, HVAC contractors, if the winter slows you down, you want to make sure that you build that drip or payroll buffer now. So that extra account, that optional payroll buffer account is not optional. You want to have that in there to help with those valleys, right? The peaks, you're making a lot of money. You got to put some of that aside so that when it comes down to the valley, you've got it available to you. And that's where I wanted to tell this story. So I have a client who, they every September, October, November, they slow down significantly because they are tied to the housing market when people sell houses. So you've got the summer, everybody's selling houses. I'm based here in Boise, Idaho, where we've got a winter, right? And so it's very common for everybody to list their house late spring, just as school's getting out, May, June, July, August. Real estate market is pretty hot because everybody wants to move before the school year. And that's typical everywhere. I get that. But the point being, then we have hunting season. And so when hunting season starts in September and October, it really slows down. A lot of people go hunting here. And so then the whole season starts to kind of slow down. So my client gets slow during those months. And then on top of that, in November, they have a lot of big bills. They've got their CRM that they pay for on an annual basis for all of their employees, $1,000 per employee. And then they have their insurance renews and they pay that on an annual basis. So in November, they have a lot of money coming out of their account plus payroll for the people that are still working and not a lot of money coming in. So having the profit first system in their business has allowed them to kind of take the edge off of all of those things happening, because now they've got the accounts built in where, as we did the monthly nut or the monthly burn exercise, they knew exactly how much money they needed to make every month to cover all of their bills. And so as they do that and they cover their expenses, now there's no, where's this money going to come from? Are we going to be able to eat because now we can't pay ourselves enough? They have it all systematized. And so they know they can make those payments and continue to make themselves paid as well in their owner's pay account. So that's the brilliance of the system. That's the beauty of being able to help entrepreneurs be more successful. If you're not doing job costing, if you're a bigger contractor doing bigger jobs, I should say, longer term jobs, more than one or a couple days, and you can't see your margin by job, you're just guessing, and guessing can get expensive. So one area you might want to look at is job costing, where you know exactly how much money you're making per job, and you might even allocate based on each job and when it gets finished. So here's your assignment. Start day 1 through 7. Open the accounts this week. Do your allocation on Friday. Do that first allocation this Friday. And if you want help dialing in your exact percentages, or if you want to set up job costing, cash flow forecasting, book a call with meetwithsavvy.com. You can also go to savvytaxstrategies.com/quiz, and you can take a quiz. It's about 5 minutes, maybe even less than that, but let's say less than 5 minutes. You take a quiz to find out how profitable you are in your business. It just has multiple choice questions. It doesn't ask for any information until the end. Get your name and your email address, and I will send you the core chapters of the Profit First book automatically in PDF. You'll get that in your email, and then you can read the core chapters of the book before buying it if you want to. That way you can kind of see the ideas behind it and everything that we just talked about. So go to savvytaxstrategies.com/quiz, and you can get that, do that quiz for you and just see how profitable you are. You can also book a discovery call there if you want to talk about implementing Profit First in your business. So with that, I thank you so much for checking out this episode of the Savvy or Surrender podcast. Remember to like and subscribe this video on YouTube. And if you're listening on the audio version, then feel free to leave a review, especially if it's 5 stars. If it's not 5 stars, I would love an email. You can email me, podcast@savvytaxstrategies.com, and let me know what you would like to hear. If you have any questions, you're welcome to leave a question there that I can address on the podcast. I would love to be able to talk to you. With that, have a great week. I will talk to you next week where we break down Profit First even further into the different accounts, cash flow forecasting, tax strategies, all those things on the Savvy or Surrender podcast.